Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of CSX Corporation, ticker symbol CSX. Currently, CSX is trading for $32.02 per share. Over the last year, their stock price is down 11%. Going back 5 years, however, CSX is compounding at a rate of 13% annually. Over 10 years, they're compounding at a rate of 16.5% annually. And going back prior to the global financial crisis, over the last nearly 18 years, CSX has compounded at a rate of 16% annually. So their stock price is up more than 13 times over this period. Additionally, CSX pays out a 1.2% dividend yield, so that would be added on to this compounded annual return. CSX normally does not have a lot of volatility in their stock price. They're down about $6 from their 52-week high, and they're up about $6 from their 52-week low. They are a very large business. They have a nearly $69 billion market cap. For background about the business, operating in the eastern United States, Class 1 railroad CSX generated revenue near $12.5 billion in 2021 on its more than 21,000 miles of track. CSX hauls shipments of coal, which are 13% of consolidated revenues, chemicals, which make up 22% of revenues, intermodal containers, which are 16% of revenues, automotive cargo, making up 9%, and a diverse mix of other bulk and industrial merchandise. The company serves various cities in 23 states east of the Mississippi, as well as the District of Columbia and the Canadian provinces of Ontario and Quebec. It owns and leases approximately 3,500 locomotives, and it also serves production and distribution facilities through track connections. CSX Corporation was incorporated in 1978 and is headquartered in Jacksonville, Florida. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of CSX based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public. It will continue to improve and get better over time. So with that said, let's get right into today's analysis. Starting with some of the key points around a potential long thesis for CSX. As part of the long thesis for the railway industry as a whole, compared with trucking, shipping by rail is less expensive for long distances. It's 4 times more fuel efficient per ton mile and does not contribute to freeway congestion. These factors should continue to support incremental intermodal growth over the long run. Rooted in service corridor investment over the past decade, CSX's intermodal franchise has posted solid mid-single-digit container growth on average over the entire railroading cycle. Thanks to precision scheduled railroading, CSX posted solid operating ratio improvements over the past 5 years, despite losing half of its highly profitable coal business over the past decade. Then for some of the key points around a potential short thesis of the business, coal activity will likely deteriorate over the long run due in part to cheap natural gas substitution. It's potentially viewed that any domestic coal volume increases are a temporary relief in an irreversible secular decline. Additionally, normalizing rates in the competing truckload sector and easing inventory restocking could temper intermodal volume recovery in 2023, despite profitable network service improvement. And then also chassis shortages and constrained labor availability are throttling Class 1 railroad service levels and tempering carload and intermodal volume growth. So that's a balanced perspective of some of the qualitative aspects affecting CSX as a business. So now let's get into their financials. Starting off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. So there are 2 key reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. And the second is that the average publicly listed business earns about a 7% return on capital. So by asking for a benchmark of 14% or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. So over this time, CSX has earned pretty stable and pretty solid returns on capital. They're coming in the low to mid double digits. Over their last 12 months, they're earning about 15% returns on capital. However, averaged out, they are going to be just below that 14% benchmark we're looking for. CSX is producing about 13% returns on capital in a given year. So while that is solidly above average, that's just below that 14% benchmark we're looking for. And so unfortunately, this is going to be an X to start things off on metric number 1. Next up for metric number 2, here we're taking a high-level overview of the growth of the business. So we want to see revenues, earnings, and free cash flow growth over the last 5 years. And this metric is all or nothing in nature. Either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric will be an X. We'll also be including their last 12 months worth of numbers in some of these calculations here. So over this time, CSX has grown their revenues by 27%. However, their earnings are actually going to be down by more than a quarter as well. This is potentially coming off of a year in 2017 that was a little atypical for the business. They actually had more than a $2 billion income tax credit in 2017. So when we exclude this, their earnings are actually up. And additionally, at the same time, CSX has grown their free cash flows by nearly 2.5 times over this period. 2017 was a pretty low year for their cash flows compared to some of these other years. And in more normalized years, CSX has produced a good amount of free cash flow. So again, even though their earnings are technically down because of that income tax credit, we're actually going to give this metric to them as it shows that their underlying business has steadily grown over this time as well. So this is our first check here on metric number 2. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at CSX on a per share basis. So we're looking for earnings per share growth over the last 5 years. This is going to be impacted very similarly to how the last metric was impacted. So because of that atypical income tax credit, where their operating earnings are up over this period, at the same time, CSX has bought back more than 21% of their shares outstanding over the last 5 years alone. So that's fantastic as a long-term shareholder in the business. So in this earnings per share equation, both their numerator, which is their earnings, have gone up if we exclude this atypical 2017, and then their denominator, shares outstanding, has decreased. So their earnings per share are steadily up over this time. Again, making that adjustment, which seems reasonable in this situation. So this is fantastic as an existing shareholder in the business. When a company buys back shares by decreasing the number of shares that they have outstanding, they're increasing your ownership percentage in the business, which is ultimately going to increase the percentage of the business's profits that you're entitled to without you having to spend a dime. So it's almost as if the business is making a partial acquisition of itself. And so just like with any other acquisition, we want a company to be buying back shares where they're getting more value than the price that they're paying. And it looks like an attractive opportunity based off their opportunity cost. Ultimately, we want these share buybacks to be done at prices that are value acquisitive for shareholders going forward. CSX has had massive buybacks over this period. They've repurchased about a fifth of their shares outstanding. So again, making that adjustment for their earnings, this is another check here on metric number 3. Then next up for metric number 4, this is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. So their free cash flows have grown more than 2.5 times over this period, and they've repurchased 21% of their shares outstanding. So this is strong free cash flow per share growth here. This is another check on metric number 4. And so far through our first 4 metrics, we are 3 for 4. 2 things to keep in mind here as well. One is that over extended periods of time, we ideally want a company's earnings and their free cash flows to be roughly the same. If these measures were to be dramatically different over potentially 10 years or more, that could signal certain things about how accounting is done for the business, potentially cluing us into either aggressive accounting in some scenarios or outright fraud in others. Additionally, it's great to see this strong per share growth coupled with their above average returns on capital in their semi-regulated railroad industry, as this combined with some other metrics about the business are potentially one of the ways that a business is able to compound its intrinsic value per share over the long run. So those aren't explicitly metrics that we're checking, but these are all potentially financial indicators of CSX being a wonderful business. Next up for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. We want their net debt, which is total debt minus cash and short-term investments, to be below the amount of free cash flow that CSX has produced over the past 5 years. CSX ended 2021 with $14.5 billion in net debt. Since then, they've increased this a little bit. They currently have $15.5 billion worth of net debt, and over their last 5 years, they've only produced $13.4 billion of free cash flow. So even though this is an X on metric number 5, this is not necessarily that far off here. And compared to a lot of other industries, it's probably not that big of a deal that a railroad and such an entrenched business like CSX would potentially have a little more debt than something we'd want to be seeing in another type of business, for example. And they've managed to grow their free cash flows over this time as well. So the business is spitting off more free cash flows. And if they're able to keep up their current free cash flows, it would look like they're able to healthily support this debt load going forward. So again, this is an X, and if this is a potential concern for you, this would just be something that you would want to dig into the company's filings to learn about their debt profile in more detail. So far to recap where we are through 5 metrics, we have 3 checks and 2 X's, but those X's have not been off by much. Then our sixth and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially give us a risk premium to the rate of the 10-year treasury yield and give us another reason to be potentially interested in CSX. So we're using their total enterprise value here to give us a perspective of the business that's going to be more similar to as if CSX were a private company. So currently they have a total enterprise value of $84 billion, which takes into account both their market cap and their net debt position. And we learned that over the last 5 years, they produced about $13.5 billion worth of free cash flow. This means that in an average year, they're producing about $2.7 billion worth of free cash flow. So when we divide their $2.7 billion worth of free cash flow by their $84 billion total enterprise value, that gives us an average free cash flow to enterprise value yield of 3.2%. So that's going to be a bit below where the rate of the 10-year treasury yield is at right now. And that is below that 5% mark we're looking for a potential risk premium there. So on an average basis, this is an X here on metric number 6. Keep in mind that it's worth being aware that over their last 12 months, they produced $3.5 billion worth of free cash flow. So to get a current free cash flow to enterprise value yield for the business, when we divide their $3.5 billion of their last 12 months worth of free cash flow by their $84 billion total enterprise value, that gives us a current free cash flow to enterprise value yield of about 4.2%. So that would be slightly above where the rate of the 10-year treasury yield is at right now. But again, that's just slightly below that 5% mark we were looking for. So either way you slice it, this is an X here on metric number 6, but just because this is the case does not necessarily mean that you're going to throw this business out in its entirety. This is just 1 out of 6 of our metrics that we're looking at, and this analysis is meant to be taken in holistically. Then finally, here we're taking a look at CSX's dividend profile. So again, CSX is paying out about a 1.2% dividend yield, which is slightly below that of the yield of an S&P 500 ETF currently. In all 5 of these years, CSX has increased their dividends that they're paying out. This is partially as a result of their share buybacks over this period, so quite a bit of their capital has gone to repurchasing shares. Additionally, they've also grown their cash flows over this period, and in all 5 of these fiscal years, they've had more than enough cash flows to be able to healthily support their dividends. And so it's ultimately going to be up to the business in terms of how they're managing both their debt loads and their capital allocation in terms of how they're going to be paying out dividends going forward. Then finally, here we're using a discounted cash flow model to come to a potential fair value for CSX. So starting with their current free cash flows per share and then projecting those out over the next 20 years based off of historical growth assumptions for how CSX has been able to grow their free cash flows over the past 20 years. It's up to you to do the work here to understand whether these historical growth assumptions are going to be both accurate and potentially applicable to give us a baseline projected estimate going forward for CSX. So based on these assumptions, if we're using a growth stage over the next 10 years where they're growing their free cash flows at a rate of just over 7% annually, and then we apply a terminal stage to the business over the 10 years out after that, where they continue to grow their cash flows at a rate of 4% annually. If we're adding in their tangible book value today, which is going to be skewed down based off of how the accounting is done for their share buybacks, and if we were seeking a potential 10% rate of return going forward on the business, then it looks like a potential fair value for CSX would be about $29.50 per share. Based off their current valuations, again using these same historical growth assumptions, it looks like you could reasonably expect about an 8.5% return going forward from CSX. Please keep in mind that this would be including their dividend payouts, as we would not be doubly counting their dividends here, and that a discounted cash flow model, just like any other model in any other discipline, is going to have its outputs be sensitive to its inputs. So through deeper research about CSX, you'll be able to determine whether or not these are potentially accurate and reasonable assumptions for their growth over this period. And most importantly, please be mindful that this analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make research researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only 99 bucks. So check it out if you're interested. So in summary today, CSX has a split checking 3 of our 6 metrics. So they had 3 checks and 3 X's. All of their X's were just very slightly off. They're earning average returns on capital of about 13% annually, which are better than that of an average business, but just below that 14% benchmark we're ideally seeking. Then they've managed to grow their revenues and their free cash flows over the last 5 years, and because of a one-time tax income credit, their more normalized earnings are up over this period as well. They've also repurchased 21% of their shares outstanding, so that puts them in similar company to one of their larger peers, which is Union Pacific Corporation, which has also been engaged in massive buybacks over the past 5 to 10 years. That's one reason you'd potentially want to keep a closer eye on CSX going forward into the future. Then it looks like the company is utilizing just a bit more leverage than we'd ideally be comfortable with, based off how they've been able to produce free cash flows over the last 5 years or so. However, they have increased their free cash flows over this time, and they've done so in spite of declining coal shipments, which is rather impressive for the business. So again, that's more similar to how Burlington Northern Santa Fe has operated over this period as well. Then on both an average and a current basis of their free cash flows compared to their enterprise value, it looks like the yields that those are giving us are just slightly below what we would ideally be comfortable with, seeking a 5% yield or better to give us a potential risk premium to the rate of the 10-year treasury. Also looking at their dividend profile, they've managed to grow their dividend payouts and be able to healthily support that with steady and growing free cash flows. The future of their dividend is going to depend on how management is approaching capital allocation. You'd want to dig into their filings and read through some of their recent earnings call transcripts to understand management's approach to capital allocation in more detail. Then finally, performing a discounted cash flow analysis of CSX based off those historical growth assumptions. It looks like from today's valuations, you could reasonably expect about an 8.5% rate of return going forward from CSX, and that if you were seeking a potential 10% rate of return going forward on the business, that you could have gotten that from where CSX's share price was earlier in 2022 in October. It's worth reiterating that this type of analysis is not a buy or sell recommendation of any security, and it's not financial advice. It's up to you to do your own due diligence here. And please, if you have any questions, consult with the properly licensed and registered legal and financial professionals. Instead, this analysis serves as a beginning and holistic understanding of CSX to help you determine whether or not it's worth your time and energy to dig in and learn more about the business. As a value investor, you're ultimately trying to learn about a business as if you're going to own 100% of it, and you can truly understand the essence of that business and know what's important and what's not important for the business going forward. As you conduct this deeper research, you'll learn more about the qualitative and the quantitative aspects of CSX's business, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of CSX Corporation, ticker symbol CSX. If you enjoyed today's analysis, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about CSX with me, and have a great day.